afternoon to everyone. I'm sure, since morning we have been listening to very interesting observations about the aluminum industry in variety of things, production, changes, new conductors. The recent one was equally interesting. We actually are going to deal with a very different topic altogether. You people from the production side, technical side may or may not probably appreciate the aspect, and which is why we thought might as well probably run through this entire bit, tell you in detail. And we have a very interesting and a specialist panelist with us who can throw light on variety of things to really give you a very 360-degree angle of what we bring to the table. Now, when I say we, I'm essentially indicating about multi-commodity exchange and our business model. So we are basically, a commodity exchange, and this very basic, I would say, attribute or a feature or most, the critical responsibility what we have is price discovery. Easier said than done. When I say price discovery, is that whatever we list on the exchange, we are regulated by SEBI. So whatever we list, the amount of disclosures we do as to what is listed and all of that, and that gives a lot of support and confidence to the participant, and that results into the price discovery of the underlying commodity. Now, today being the day for aluminium, we want to discuss at length about what has been our experience about aluminium and this thing. But I am also taking this opportunity to tell you that when an exchange looks at a value proposition like say aluminium contract, what is the variety we can do and what extent we can do, and which is why with me panelist, one of my colleagues is Prakash, Prabhu, who's part of our products team. We also have Mr. Kaushal, Mehta, who is Senior Vice President at Motilal Oswal Financial Services Limited, and Nikunj Agrawal, who is Director of Pilot Industries, one of the renowned names in the refined lead production side up north. And I am sure, I think the fresh initiatives what they have is, slowly this is going to go pan India and going to help us a lot, because we in MCX think a lot about spreading or taking the message and the price discovery platform to multiple centers, so that the price discovery becomes holistic, the referencing becomes common, the benchmark is uniform to all the value participants in the value chain, and so on and so forth. So what we have done is we're going to let the panelists present their case, present their inputs turn by turn. So starting with Prakash, then we'll invite Kaushal and then Nikunj, and thereafter we will open the forum for Q&A as well, in case if anybody has any queries on that. But essentially the idea is to give you a 360-degree angle of what exchange brings to the table, what is the utility, and how do you how one in the value chain can really make use of it, because we want to produce a quality product, we want to give service to our clients and all of that, but we realize on ground that it is at the price at which you are doing, and you want to be competitive, you want to be competitive, you want to be profitable, and all of that above can only work when you have a financial instrument with us to help us out on that. So let me invite first Prakash, Prabhu, who is going to tell us about the aluminium contract and how the hedging and stuff happens. He has been with MCX for last year or so, and prior to that he holds a vast experience, about 14 years of experience in the commodities market. He has done immense contribution to our lead brand empanelment initiatives as well, and with his background of being analyst both from the technical side and the fundamental side, I'm sure he's going to give you a very good start to the discussion, and we'll pick it up from there. So over to you, Prakash.
Thank you very much, sir.
Perfect, we can see it.
Yes, sir. So good afternoon, everyone. Welcome to the session on utility of metal futures contract for risk management purpose. So broadly, we are going to cover the utility of the metal futures contract which are listed on the exchanges. How can you use those contracts for the purpose of risk management. And we will take aluminum industry as an example in today's presentation. So these are the broad topics which we are going to cover today. First, what is the impact of doing business without volatility? We will understand that. Then we will take the example of aluminum industry in detail. Post that, we will explain you how the exchange price is pivotal to everyone in the value chain. Then how the hedging mechanism, how the corporates can hedge their requirement by using base metal futures contract, and what are the products which are listed on the exchanges. So moving ahead, there are particular businesses has different sources of risk, which includes foreign risk, interest risk, credit risk, operational risk, investment risk, and one of the risk is also the commodity price risk. Now, most of the corporates have a habit of or habitual in hedging their foreign exchange risk and other risks. But as far as commodity price risk is concerned, there are very few corporates who are engaged into hedging their commodity price risk. So what does it include? What does commodity price risk means? So it means it could include increase in purchase cost vis-a-vis commitment on sale price, the value inventory may change, the change in the value of inventory, the counterparty risk translating into commodity price risk, and how you can hedge your commodity price risk. That is using it can be hedged using commodity base metal futures contract, and which certainly I will explain you with the help of one example. Now, before moving ahead, let us have a look at volatility in aluminum for the financial year 21-22. For the last financial year 21-22, the volatility in aluminum was 27.76%. Now, what does this eventually mean is that any businesses or any firm in aluminum business with an annual turnover of 100 crores was exposed to a price risk of 27.76 crores. Now, isn't that phenomenal? Does any businesses even have that kind of profit margins also? So from this kind of volatility from this kind of figures, it is very important for the value chain participants of the aluminum industry to understand that they must hedge their business requirement using the base metal futures contract, which will help them to protect their bottom line, so protect their bottom line of the companies. Now, moving ahead, before going into the hedging, let us understand the value chain of aluminum industries. I have taken an example of aluminum. So from miner, it goes to the refiner. After refining, it goes to the converter, and finally to the auto industry. And post that, there is one more industry which is called recycling industry. So after that, it goes to the recycler. Now, it is important for each and every value chain participants to understand that fluctuation in price or volatility in aluminum prices affects all these participants in some or other way, be it a miner, be it a refiner, be it a auto industry, be it a converter, or be it a recycler. So hedging is important for each and every value chain participants of the aluminum industry. Now, as I explained the value chain participant, now Indian primary industry consists of three major players, which is NALCO, Hindalco, and Vedanta. With a smelting capacity of 4 million tons. After that, it comes. There is a huge intermediary and processing industry which converts aluminum to be consumed by the end users. They are nothing but the manufacturers of auto component, transmission cable, beverages cans, etc. And after that, finally there is a parallel industry which is called scrap recycling industry, which works across the industry segment to cater the respective needs. Thus, aluminum the price fluctuation. Aluminum has direct influence on automobile industries, power grid industries, packaging industry, etc. So it is important for all these industries to hedge their requirement using base metal futures contract. Now we now come to hedging. Now, what is a hedging? Now, hedging is a risk management tool, a sort of insurance against the adverse price movement. It's a fairly simple process where the company takes exact opposite position to the physical exposure, which negate one another, making company price risk free. So the purpose of hedging is to eliminate the volatility, eliminate the price risk, eliminate the kind of volatility that is there in the base metal today. So how you can eliminate, I will explain you with the help of example. And most importantly, the purpose of hedging is not to make profit or loss. It has nothing to do with the speculation. The purpose of hedging is to lock in the prices of the raw materials. That is a very important thing to note, that purpose of the hedging is to lock in the prices of the raw material and ensure that bottom line of the company is not affected due to the fluctuation in raw material prices. Now, if you are a consumer, he buys on exchange. Why he buys on exchange? To protect against the rising prices of the raw material or the relevant base metals. If as a producer, he sells on the exchange, they hedge by selling, by taking a sell position on the exchange. Why? Because to protect themselves from falling prices of the raw material or particular base metal. Now, let us take one example. Now, tender is passed on 1st July for transmission cable supply. Now, it requires to procure 100 metric tons of aluminum in all, and the pattern of purchase is such that it needs to buy 20 metric tons every week. So on 1st July, the company buys 20 metric tons of raw material from the physical market. Thus, the first lot has no price change threat. Now it wants to, the company wants to ensure that whatever 80 metric tons which are they will be purchasing in the during the next 4 weeks, they want the same price which they purchased their first batch, that is 20 metric ton on 1st of July. Now, but however, if you take the current price volatility, can that be guaranteed that whatever the price they got on 1st July will be that price they will get during the subsequent purchase? Definitely that cannot be guaranteed. So what is the solution? So one must hedge. If you look at the bottom box, how you can hedge on 1st July, buy aluminum near month contract. Quantity should be 80 metric ton, and you should reverse those positions proportionally as and when raw material is procured physically. Why 80 metric ton? The initial requirement was 100 metric ton, out of which 20 metric ton was already bought on 1st July. Now this company needs to hedge the balance quantity which they have not procured yet, which is 80 metric ton. So they will buy 80 metric tons of aluminum near month futures contract on the exchanges, and they will reverse the same proportionally as and when raw material is physically procured. So again, I am repeating, the objective is to lock in price of raw material and not to profit from the change in prices. So this is very important aspect of hedging. So what happens to this position? Now just assume that the 80 metric tons was bought at 205 per kg of July aluminum futures contract on the exchange, and assuming that futures and physical converge. Now next week, that is on 8th of July, this company goes again into the physical market and buys the requirement of 20 metric ton, assuming that prices during that week has risen to 208. So in during the physical purchase, they had to pay 3 rupees extra from the previous week. Though the total outgo is 41,60,000, as you can see in the table. Now now they have taken a buy position on MCX 80 metric ton. Once they have bought into that 20 metric ton on 8th of July, they will exit 20 metric ton of position on which is taken in M6 futures contract. That is, they will exit 20 metric ton from the future aluminum futures contract. Now the price of M6 futures is 208 at that point of time. So total profit on MCX is 3 rupees. So the loss in the physical market is done good by the profit in the futures market. So the excess amount, so the profit in the futures market, you can see it is 60,000. So net cost in the books, as you can see the last column, it is 41 lakhs, and the budgeted price comes to 205 per kg. So during the first week, what has happened? The prices of the aluminum has risen, because of which the company has to pay more in the physical market. But that loss in the physical market has recovered due to the gain in the futures market. And ultimately, the main aim of the company was to ensure that they pay 205 per kg for all their purchases is been achieved. Now, on the 15th of July, again the company goes to the in the physical market and buys the buys their requirement, assuming the prices have fallen at that point of time. So they will certainly pay less in the physical market. So total outgo during 15th of July was in the physical market was 40,20,000. But although they paid less, but since they had taken a buy position on M6 futures contract, certainly the prices have fallen by 4 rupees. So they will have to suffer a loss on the position taken in futures market, which is 80,000 rupees, as you can see in the table. So again, the net purchase cost is for 40,20,000 plus 80,000. So net purchase cost per kg comes to 205 per kg. So the purpose of the hedging is to ensure that for all the subsequent purchases, the company is able to procure the aluminium at rupees 205 per kg. Either market may move up or move down, that becomes irrelevant for the company. They just want to ensure that the end price of the raw material is 205 per kg, or the procurement price is, or budgeted price is 205 per kg. So by setting up this strategy, this company has achieved its objective and ensured that for all the subsequent weeks, also for 22nd July and 29 July, irrespective if the prices has gone up and gone down, they were able to purchase their raw material at the budgeted price of 205 per kg. So that is the purpose of hedging, to lock in the prices of raw material and to eliminate the risk due to the price volatility that is happening in the today's scenario. So again, this is compliance and disclosure. So section 43(5) of the Income Tax Act says that profit or loss on hedging transaction can be offset by business profit and losses. So this is just the compliance and disclosure. Now, why corporates don't hedge? Now, first reason is that lack of awareness about the concept of hedging, especially in small and medium scale industries. So this is a foremost reason why corporates don't hedge. Many the corporates are not aware about the manner in which they can use the exchange platform or the base metal futures contract listed on the commodity exchanges to hedge their requirement and to ensure that they are protected from the price risk, volatile markets. So that is one of the foremost reason why corporates don't hedge. Second is conventional way of managing price risk continue, which is built more on hopes and trust than anything. Means they just assume that if they are suffering a loss at present, they just hope that in future they will make profit due to the price fluctuation. So they just stay with the hope that whatever loss has been occurred now will be recovered in the future. So that is another reason. Then again, third is the notion that is a speculation, and which also is termed as satta. So there is an impression that this hedging means speculation. So I clearly explained with the example that hedging doesn't mean speculation. It has nothing to do with profit or losses. The main purpose of hedging is to lock in the prices of the raw material. Fourth reason is coming to the term, that is to take the position on the commodity exchanges, or to take the position in base metal futures contract. One has to deposit the margin, which is approximately 10 to 11%. So one has to deposit margin again, and also keep themselves up to mark to the mark to. They also make good. They also have to pay daily mark to market margin also. So paying upfront margin and paying mark to market margin is also one of the reason why corporates are not hedging. Lenders and regulators have not yet stressed adequately on management of the commodity prices. This is again one of the foremost reason why the corporates are not keen on hedging, because the banks and other financial institutions and regulators, they are not yet stressed this small and medium scale enterprises to manage their price risk, commodity prices using the base metal futures contract. So these are the few reasons why the corporates don't hedge as per their business requirement. Now, what are the base metal contracts that are listed on the exchanges? Now, at present, there are 5 base metals contracts which are listed on the exchanges, which is aluminum, copper, zinc, nickel, and lead. Now, we'll focus more on aluminum here. Now, the aluminum contract is available as per contract launch calendar, and start day is the first day of the contract launch month, and if that day is a holiday, then the following working day. And last trading day is the last calendar day of the contract expiry month. However, if that day is holiday, then the preceding working day. Now, trading unit for aluminum is 5 metric ton. Now, what does this mean? That whenever you are taking the position in aluminum futures contract, you have to take minimum 5 metric ton or in multiples thereof. That is 5 metric ton, 10 metric ton, 15. So it has to be in multiples of 5. So one lot is of 5 metric ton. One lot of aluminum futures contract is of 5 metric ton. So for zinc and lead, it is also same 5 metric ton. For copper, it is 2.5 metric ton, and for nickel, it is 1.5 metric ton. So quotation value is 1 kg. That is the prices which you see on the terminal. Prices for the aluminum which you see on the terminal is for 1 kg. So whatever price you see on the terminal is for 1 kg. And the price code for aluminum is X warehouse Raipur district. Now, Raipur is the primary delivery center for aluminum. Tick size is 5 paise per kg for aluminum. So what does it mean? That the minimum difference between the buyer bid and ask is 5 paise per kg. Now delivery unit and trading units are same. The only the delivery unit has come up is there with a tolerance limit, which is 10% in case of aluminum. So what does it mean? That any value chain participant who wants to engage into delivery of the metal, they can deliver the metal, and the weight can be between 4.5 to 5.5 metric tons. So that is the meaning of 10% tolerance. So it is not necessary that the weight should be exactly 5 metric ton. It can vary by 10%. Delivery center, the primary delivery center, as I said, is for aluminum. It is Raipur district in Chhattisgarh. Initial margin is 8% plus minimum 1% of ELM. So as I said earlier, that why that the reason one of the reason why corporates don't hedge, because to take the position in base metal futures contract, they have to pay the initial margin, so which is approximately 10%. So this was the basic contract specification of aluminum, which is listed on the MCX. Now, just a glimpse of volume, that is volume and open interest that is there on the exchange. Now, prior to March 2019, all the contracts were cash settled. Post that, each and every base metal contract has been converted into converted into delivery based settlement mode, and GST implementation facilitated the delivery based settlement of all this contract. Now, if you look at the aluminum in the first row, the average daily turnover for the financial year 21-22 was 607 crores. And if you look at the average daily volume in metric tons, it is 26,800 metric tons. So that is the kind of volume that is taking place in aluminum on daily basis. So this is the average daily volume in crores and in metric tons. And average open interest for the financial year 21-22 was 13,879. That was the average open interest. So that kind of volumes is taking place in aluminum futures contract, which is listed on the exchange. So that's it from my side. So any query you have, please do let us know.
Thanks, Prakash. I would request the participants to keep themselves on the mute while someone is presenting, so that we can patiently listen to all, and we will open up the forum for the Q&A towards the end. So I mean, when I said that Prakash is going to set the tone of the discussion, so essentially in terms of theme, if you analyze what Prakash essentially mentioned, was that the exchange basically creates a standard mechanism, whether in terms of specification, deliveries, everything is standard. So least amounts of surprises, and that is how it becomes very easy to take a view on the prices and transact on the prices based on this thing. And which is why we believe that rather than estimating whether the prices are going to go up or go down, it is much better to actually hedge using the financial mechanism on MCX and keep the margins intact. Now, obviously, I mean, Prakash is part of our team, and we continue to believe that we are doing great work. But now let's hear it from others in the ecosystem. With the exchange, the members, in common parlance, we call them as say brokers. They are also integral to our ecosystem, and as much as we want to reach out to the widest market participant, these people also, so the members are also reaching out and trying to explain to the wider audience how beneficial it is for them to use the exchange platform. Now, I have known Kaushal for the last 15 years, and we've worked pretty closely on many assignments to explain corporates on the hedging benefits. And he is senior vice president at Motilal Oswal and heads their corporate initiative. And plenty of instances I've realized that by virtue of his profile, he has exposure and probably opportunity to meet a wide variety of corporates for variety of exposures they have, and the way he explains to them, and this thing is the reason we have invited him to be part of this session today, to give us a perspective as to what is his experience on it's convenient for an exchange to say that it's a great mechanism, but I mean, let's hear it from Kaushal as to what's his assessment of the concept and how he assesses the benefits of this to the corporates. So Kaushal, over to you now.
Thanks, Chitranjan. Can I get the sharing rights? So it's already there.
Yeah.
Yeah, just a second.
Yeah. We can see the Explorer, but not the PPT. You want me to share the one?
No, wait. So able to see now?
No, it is still showing the Explorer. You will have to open the file and then probably.
Yeah, it's open at my end.
So why? So probably you stop sharing once.
Okay.
And then you start again. Probably then it will throw up the file. So while yes, now we know. Integrating regions into the national price benchmark via multiple. Perfect. You can see it.
So good afternoon, everyone. Chitranjan has already briefed you with my introduction. Myself, Kaushal Mehta. I work with Motilal Oswal Financial Services Limited, and I've been a part of the commodities market for over 15 years now. So I've been through the entire evolution of in the Indian commodity markets, and how the contracts were initially launched and how they matured and how they were modified and improvised from time to time. So what I'll take you through in this presentation is how the present contracts which are traded on MCX are beneficial to the corporates in terms of price discovery and for hedging purposes. So let's go through the presentation and I'll take you through each slide. As I discussed, the MCX or the Indian Commodity Exchanges started in around 2004-2005, and around that time when the exchanges listed the contracts, we had base metal contracts which were settled as per international pricing. So we had prices either derived from COMEX or LME, and the contracts used to mature as per the international say cash settlement prices and converted into INR, and these were non-deliverable and only paper trading used to happen. So while it's good to have a derivation of international contracts and have a replica here, but there was a lack of corporate participation for the very reason that companies used to think that the domestic markets at times used to not move in tandem with the international markets, because domestic markets may have scarcity or surpluses of that commodity, and there used to be premiums and discounts of those commodities. So a lot of companies viewed these kind of contracts as very speculative, that eventually if there is no delivery, so it's only paper transaction, and it's very difficult for them to keep a track of what is hedged and what is not hedged. And there are times when the local market pricing deviates from the international market pricing based on demand and supply. So over many years, these things were debated, and eventually exchanges came up with the idea of deliverable contracts. And we have deliverable contracts across base metals, copper, zinc, aluminium, nickel, lead. And these deliverable contracts were launched with a lot of success. So we, as a financial service provider, we saw almost 10 times greater participation from the companies the moment they saw that the contracts are now physically delivered. Because companies used to fear that if they are short commodities, if they have sold some forward contracts, and if there is a speculative attack, and if the price rigging happens and prices are moved up, then what do? So here they know that if they have sold some contracts, and if the prices are artificially moved up, they can even give delivery and come out of it. So every contract can actually be delivered on the exchange platform, which made companies very comfortable, and which saw a lot of interest from companies, both large and small and medium enterprises. So that was the first phase of launch, where the contracts from being cash settled moved to deliverable contracts. With delivery, corporate participation increased. Now, as the exchanges launched the contracts, there was, because it was the first time delivery based contracts, we used to have deliveries in one particular location for each commodity. So say there is a commodity which is traded in Chennai, so we used to have delivery in Chennai or in Maharashtra. Predominantly, it was all Maharashtra centric. So we had a lot of participation from the western region, and probably some bit of participation from north and south, but we lacked participation from the eastern region because of logistics and transportation issues. So in the next phase, what we saw after seeing the success of the deliverable contracts, in a couple of years, the exchanges expanded the network and created a warehouse ecosystem wherein we have multiple delivery centers. So we have a commodity which can be delivered at least 3 or 4 locations at the country level, so that we get participation from all the regions. The northern guys can participate, the eastern guys can participate, the southern guys, everyone can participate equally. This also means that we are in some manner making MCX prices as the benchmark prices. So say for aluminium, it's already been observed, a lot of traders, they start quoting basis MCX. So the physical selling price is basis MCX, say MCX plus some certain premium or minus certain premium. So what we are observing over a period of time, that MCX has started becoming a benchmark, because one is the price discovery is happening locally. We have domestic pricing. We have deliveries which are happening domestically, and therefore, rather than taking some international references, there is a market which is started to being created where the domestic market prices are started being quoted. And further to that, in the most recent development, what the exchanges have done is we have domestic pricing with domestic warehouse locations, and we also have domestic participants or domestic quality specifications being delivered. So earlier, all these whiles, when the delivery contracts were announced, what used to happen is the price quality the product quality used to always be LME grade. But now in the most recent times, we already have a product quality which is they have approved refiners or they have approved companies whose products can be delivered. So these are benchmarked at as par as maybe a LME grade. But since the whole objective or the whole exercise for the exchanges and for the country is that let us have our own price mechanism and let us have our own price discovery. So we have our own product grades which are acceptable delivery. It has been successful in other commodities in bullions where this domestic manufacturer's quality is approved. And same way, we are seeing success in the base metal contract also. We have our next session by Mr. Nikunj Agrawal, who will obviously take you through this in more detail. But the whole idea of me describing this is, the exchange and the forward booking or hedging mechanism on the Indian market has evolved in a very big way over a period of time, from purely deriving contracts or deriving prices from international markets to having physical deliveries in domestic markets, to having deliveries in multiple locations in domestic markets, and to having even our own grades and being delivered. And by my own experience, what I'm seeing is that the proportion of corporate participation, say at the time when the exchanges were only referring to international prices and trading, was less than 10%. It has now become almost 50% of the total trading volumes. So there is very high demand for the commodity exchange platform by corporates. So why this increase in corporate participation is, say, first reason is that we are actually seeing the domestic market availability of that commodity and the premiums and discounts being quoted in the domestic market for that commodity reflected in the price on MCX. Earlier, what used to happen is that while the international prices could be X, but due to some scarcity in the domestic market or due to some surplus availability in domestic market, domestic pricing was different. So hedgers could not participate very efficiently. But now with this scarcity or surpluses being captured very efficiently because the underlying commodity is deliverable, hedgers are very comfortable because they are exactly getting the premiums or discount being reflected on the MCX prices. And therefore MCX has become a very good tool to hedge. So somebody who wants to not deliver and just do paper hedging is also far better off than the earlier way of doing paper hedging. So they can use this exchange platform. Another thing is, like I said, that now we have a wide variety of wide range of warehouse locations across the country, which I'll take you through in my subsequent slides. So when I'm talking about the warehouse locations, we have, say, aluminium being delivered at 5 locations. So the base center is Raipur, Chhattisgarh, which is the price which is quoted on the screen is X Raipur, Chhattisgarh. And then somebody who is a participant from, say, Maharashtra, he can deliver in Thane. Somebody who is from North India, NCR region, they can do it in Haryana. Somebody in Chennai, so Calcutta. So essentially the whole objective is that we are covering the participation from all India, pan India level. So we have a warehouse in Western region, we have a warehouse in Eastern region, Southern region, and Northern region. Likewise for other commodities. So we are gradually seeing that the awareness being spread across all regions at the country level, and seeing participation from various pockets of the country. So this is a glimpse of the kind of quantity being delivered on the exchange. So for aluminium, if we say we are doing close to 3,000 to 4,000 metric tons every month physical delivery on the exchange platform. So when I'm saying 3,000 to 4,000 metric tons in a month, that is a good quantity considering this is about a 2-year-old phenomena. The market is, we have added locations and we have added warehouses, so this market is expected to go much more beyond here. And another thing is, while the quantum delivered is say 3,000-4,000 tons, the open interest and the contribution by corporates, which is participation on the exchanges, have developed manifold. Likewise, for lead or zinc or copper, we what used to be a paper trading has now converted into deliverable trading, and we are seeing more and more deliveries being happening on the commodity exchange platform. What needs to be you know,
I can't hear you, Kaushal. Are others able to hear him?
No, I think his screen is.
No, I think he is. What is it?
There is some network issue, I think.
I think network issue. Yes, yes.
At his end. Okay. Oh, great. So I think he has logged up. But I have very little idea of how far he has been through his session. But I think he made his point pretty clear in terms of explaining this thing. So why don't we do one thing? Why don't we probably invite our next speaker? I am very sure that Kaushal will resume and he will connect back, and we will probably touch base with him once more to let him complete his point. But in terms of expanding the warehouse footprint and all of that, what Kaushal mentioned, that's clearly setting the tone of the thing. But what is toward the end, what he mentioned is very more critical, is that MCX is now aiming to include and provide opportunity to all the domestic producers who can actually create a quality product. So the underlying of what we are trying to say is that price discovery is a phenomena of creating standard product, and for creating standard product you need a backing from people who can actually create a quality product consistently and deliver on exchange, so that the price discovery becomes really transparent and it reflects what's happening on ground. Now, our initiative on the refined lead, while this is slightly outside the aluminium thing, but I have a reason as to why we want to hear Nikunj Agrawal. So let me first invite him, and once he's done, then let me give you a perspective of how we look at it, what we are doing in the refined lead, this thing, to how it connects back to the aluminium and the associated industry. So Nikunj is. I've been interacting with him for last 2.5 years, and very dynamic guy. Third generation from the family, quality produce. Guys, they are suppliers to all the leading manufacturers. He himself has been driving a lot of initiatives within the company. So, and this I would say initiative to get it listed on MCX is also, I think, part and parcel of what the entire thing was overseen by Nikunj. So why don't we invite him and hear it out from him as to what's his take on his experience with the MCX.
Hi,
Over to you, Nikunj.
And thanks, Chitranjanji, for inviting me today. It's a good platform to showcase the deliveries, how that's helping the industry. Should I share my screen?
Yes. Yes. Perfect. We can see it.
Okay. One second. Yeah. Hi everyone. So I'm just basically talking about how the branding of domestic producers is going to help the domestic industry. just a small brief about our company, Pilot Industries. We're one of the leading recyclers of battery scrap in India. It's a family-owned business since 1969. And we have a facilities in Rajasthan and Andhra. So, both the markets, north and south. And we are basically exporting as well as supplying domestically to all OEMs, and having exposure to the domestic as well as the international market in terms of pricing. That is the LME and the MCX. So when MCX initially introduced deliverable contracts, they were only taking in the LME approved brands, which was becoming a challenge for the other producers to actually hedge ourselves in case any about any risk or anything. So I think we all had a discussion with the in the PAC committee of MCX for lead, and therein it was finalized that MCX will approve domestic brands, and hence this is sort of the result of that we got listed in Feb. It took us a good amount of time because it was the first few companies to get listed. Almost, I think, 1.5 year. Chitranjan ji, Prakash ji, everybody was working towards it, and the process was pretty extensive. I feel that they involved the actual customers of lead, which was actually very critical, so that the material that comes in just doesn't keep lying in there, and actually it's usable by the end users, the battery manufacturers, or anyone. It's a basically domestically approved or internationally approved grade, in fact. So yeah, so about branding, how it's helped us. I mean, how Kaushal ji here was pointing about the pricing mechanism. With the deliveries coming in place, the price on the exchange in the physical market is started to come in tune as the volumes have increased, as the producers actually, or the manufacturers have started showing interest in it. We've seen over the past 2 years or 1.5 years that the difference between the domestic prices and the exchange is narrowed down like hugely. Earlier, there was a lot of dependency on the local prices of the markets in India. Like, metal industry is really guided by these SMS prices, or like, local prices of every region, like north, south, east, west. So now everybody is talking about, how let's deal on the MCX price. So it's becoming a well-known benchmark. Like, when we're dealing in international markets, we know that LME is a reliable source where it's coming from. And, that has led to this one nation, one price motto that, MCX has been following for not just lead, for all the metals. Now, all the producers, consumers, pan-India are dealing on a common reliable price, basically. Earlier, most of the producers were either discussing that, this price is not reliable whenever there was a big move in the market, that, the domestic prices should fall, or, the demand is such, still prices were not moving. So it's like an authentic benchmark. And one major benefit that, all the producers would actually feel is that MCX has warehouses now all over. So all the producers have a customer now at any time and any price. I mean, that is not something you usually get in the physical market, that, okay, today suddenly the price is going to drop, or, it's going up and you want to sell. So you're probably your customer, normal customer, would not buy. But here, the major benefit is this. So I think that's sort of like, it sums up what I've said. Like, benefits in terms of pricing, deliveries, everything is pretty smooth. And I would like that, anybody has any questions, especially, from the forum, aluminium guys, or, MCX themselves, that, you want me to talk about, would be a good time now.
Great, thanks, Nikunj. I mean, it really helps. Now, before we open the forum, or probably I can come back to you with queries. Looks like Kaushal won't be able to log in back. He's struggling to, but so I have a copy of his presentation. So, and couple of slides left. So if you can let me share the screen. Then probably I will finish Kaushal's presentation, and then we can, probably run through the queries. So if I'm not mistaken, this is where Kaushal was, right?
Yeah.
Great. Sorry. So Nikunj, thanks a lot. I mean, let me just quickly
No problem.
sum up, what Kaushal had to say, and then we can open the forum for discussion and Q&As if at all. So what point he was trying to make was that from the pan-India perspective, you look at aluminium, copper, lead, nickel, and zinc. When we say our presence is pan-India, so locations where these metals are deliverable are something like this. So talking specifically about aluminium, it is deliverable at Maharashtra, at West Bengal, at Calcutta, at Tamil Nadu, at Chennai, Haryana, Palwal, essentially is also NCR, and Chhattisgarh, which is the primary delivery center for this thing. So what happens is that buyer cannot choose the location. So that is why it is suggested that you should have a GST registration at all these places. And I'm sure the regularity of business will justify the compliance over burden probably one may have. But look at the combination what we have. Essentially down the line, I am not very sure of what would happen to Chhattisgarh for other metals. But for the other four, definitely I think all metals will be present there throughout. So it adds to your benefit that having done that, if you have exposure to even more than one, it is supplementing your requirement. Another point he probably wanted to highlight was there is a regularity of display of information on the how much stocks are available on MCX at any point in time, and this is an example as to how much of quantity is available for each of the metals. So you can see this. These details are each location wise is given, how much is valid lots are there, how much is outgoing, and we come out with a separate report close to about 130 which gives granular details as to which region, which warehouse. So I mean, each region may have multiple warehouses, has got how much of metal. So this is also part and parcel of what MCX displays every time. Now to really sum up what his point was that the exchange is now trying to create that integration across India, and which is what the point Nikunj was also highlighting, that when we say one nation, one price, a predefined set of designated warehouses and locations from where one can give delivery, take delivery. So that reduces the uncertainty and brings it down to aluminium, say 5 locations at the most, and for lead it is 4, and everything else zinc is 2. So what happens is that the confusion in the system is minimum. One knows exactly as to when he has to deliver in the good, then he know the nearest proximity where he can deliver, and on a predefined way the buyer can actually take the goods out from there, and they can really calculate that if I have to, in lieu of my conventional supplier, if I am buying it on the exchange and if the metal is going to be marked from somewhere else, then they know exactly how they have to participate. They will factor in the transportation cost, and thereafter they will take a call. So in summary, what he wanted to essentially highlight was the physical delivery options enables participation of the users pan-India. Now, when I say pan-India, let me put it a perspective of aluminium bringing back. It's not only Raipur, logistically is perfect. It's a very good redistribution location for aluminium. If you try to imagine, the domestic production centers is very, very, centered around Odisha. Aditya Aluminium is Odisha. Vedanta Aluminium is Odisha. Nalco is Odisha. Balco Chhattisgarh is Raigad, which is so proximity to Raipur, and from there, Raipur is a location from where east, west, north, south, everybody can be serviced. And that is, I think, primarily one of the biggest reasons why we have a success of that location. But having said so, we still have a presence in north, east, west, and south, so that if anybody has a surplus acceptable LME registered brand with them, they can deliver it on the exchange and not saddle with the unwarranted inventory for long. Now, I don't really want to, for you guys to remember, but imagine the hard times of April, May, June of 2020 when everything was standstill and the lockdowns were in place, and all those who had inventories, all those who had goods in transit, all those who had goods in high seas, they had no other choice but to deliver on MCX and actually get rid of their metal. So imagine, I mean, on an average, currently what inventory we have is about 6,000 to 7,000 tons. In those days, we had about 27 to 28,000 tons of metal, put together. And that's how it came in. And when the unlocking happened, seamlessly the metal went out. That is what the importance, what we want to highlight. The paper hedging has become efficient. Price talks what your book number says. The exchange price is everything else included and not the GST. So you don't have to track LME separately. You don't have to struggle with rupee separately. You don't have to struggle with premium separately. No, it's custom duty separately. No Excel. You look at the MCX price and you exactly know as to reality of where the physical prices are. And in the recent times, a lot of people have been saying that the markets overseas have been crashing and the MCX prices have been following, but not to the T. That's the reality of how the reality. So I mean, one can hedge and wait for the delivery and settlement to happen, and it's a cycle which is completely entangled into itself, and that's the opportunity I think the exchanges are offering to everybody. And now, because we are at the subject of aluminium, I want to highlight one more thing: is it's not only additional delivery centers. We are also facilitating additional deliverable shapes and grades. Now, primary delivery product is ingots, without a doubt. The general parlance, everybody will say P10, 20 and all of that. But typically, the LME registered 99.7 ingot form. But we also, as a last resort, facilitate and accept deliveries of SOs, big ingots, and T-bars. And they are at a prefixed discount of 1 rupee, because I think our product committee had given us input that these SOs and T-bars are not relevant to everybody who's a buyer on the exchange. So there are people who would actually get metal and that is of no use to them. So they will have to swap it in the market and so on and so forth. So practically, in terms of delivery centers, we believe that there is no optimal delivery center. Wherever the metal surplus is, it will get delivered, which is why we don't offer any premium or discount to a location. But yes, on grades there is a challenge, and that is why we. So I believe that's what Kaushal wanted to highlight. It's very unfortunate that he had to move out because of the trouble with the line. But that's great. So I mean, it allows us some time to have Q&A. And before we do that, there are a couple of things which I want to highlight. Thanks to Kaushal's PPT, that it allowed me to tell you that on aluminium, it is not only additional delivery centers. We also can have issues. Anybody having additional grades can also be deliverable, and SOs and T-bars are also deliverable in MCX. And that is so. In fact, if you see aluminium, it is maximum delivery centers. So the rest of the contracts maximum have 4. The aluminium has got 5, including Raipur, and it has got maximum grades because it also accepts the SOs and T-bars into this thing. So so coming back to Nikunj, your point, and which is what I keep hearing a lot on ground. I want to hear it from you from that angle is, everybody has bilateral relations with the client. So when we say that MCX is a delivery of last resort, I'm sure you're going to produce metal throughout 365 days, and MCX 30 days of the month. MCX delivery period is only last 5 days of the month. So I mean, the rest of the days anyways you are dealing with the clients on a bilateral basis. Now in this bilateral trades and this thing, and MCX present, is that helping people to open up and having views on the market and still transact without haggling about the prices?
I think that is true what you're saying. I mean, people have started keeping, what I have heard, like people have started keeping inventories specifically for the MCX, that in case there's a price move or there's a fall in demand by the second half of the month, so we can keep the MCX last resort option open basically. So that is a valid point what you're saying basically.
Great. And in terms of the biggest value I believe we bring to the table is standardization. Is that quality standard? Is that shape standard? Is that packing standard? All of that, is that helping the trade in any way?
Yeah, I mean, very much. In fact, like, what one could have done is that just introduced a very simple grade which was not probably accepted in the market with the consumers, or not easily tradable. But now that you've set a benchmark as to that it has to be 99.985 grade in lead, if we talk about packing standards, ingot shape sizes, to the weight of the ingot you've specified. So it is really helping the market that even end users are not scared that, okay, this material is coming, we don't know what will happen, will it, because they're making batteries by the end of it with lead, so it's a very critical product when it goes to the consumer. So I mean, it's very, very helpful what you guys have done in terms of deciding on the quality of metal. I mean, in fact, LME also does not have such a high standard grade as compared to the MCX.
Great. No, so I mean, thanks for those inputs, Nikunj. One of the reasons I wanted specifically to get your get your opinion on this is also, this is how I'm trying to bring a complete circle, that we have done something right on, say, aluminium per se, by creating a contract for the primary producers. The metal which gets generated there is a primary producer metal. 99.7% grade ingots, what is the commercial they use the term called P1020 and all of that. But what I really wanted to plug and tell everybody who's attending the session today is that from aluminium, we also aim to do something on the aluminium alloy side, which is very akin to what refined lead, theme theory is, that if we down the line, we aim to also come out with a product which is going to solve the challenges from the aluminium alloy industry as well. Now, when I say aluminium alloy, it can be derived from primary aluminium, but also secondary is a big player in that. Number two is the application is wide variety. The automotive industry, the die casting industry, and everybody uses it in different forms. So everybody has about their own specification as to what they would like to have, and accordingly. But that's what the game is, that we are trying hard to bring. We've already, in fact, narrowed down to a perfect standard which can actually take care of the requirements of maximum people from the trade, so that they can seamlessly come to the exchange, transact, hedge themselves. And at the end, if they eventually make or take delivery on the exchange, then there is no surprise in it. I mean, moment you deal with MCX, you exactly know that this is the chemistry I'm going to get, and that's how. And I think that brings me to one question which has been put in. Can a buyer who takes delivery from the warehouse gets metal with the desired quality and specification? So my answer to that would be the what you should be seeking to get from the exchange is what chemistry or what specification we have listed. So if MCX has said that it is going to be LME registered grade of metal, so talking about aluminium, it is 99.7% purity. What we have listed is ingots. It is going to be, whatever you will get is going to be LME registered brands only, nothing else. You can get the primary product is primary in a sense. The base grade what we have listed is ingots, but yes, we also allow the delivery of sows and delivery of T-bars. So what happens is, you imagine at the time of settlement, if somebody, all the sellers, they couldn't sell their, say, suppose sows and T-bars. I mean, it is all theme and theory, but suppose they couldn't sell the sows and T-bars and they deliver on the exchange, it is the same product what will be given to the buyers. So, I mean, I don't know whether I have understood your question correctly, but on aluminium, if you are a buyer, what you can get is ingots or sows or T-bars. And in case if you get sows and T-bars, you get it at 1 rupee kg discount. That's part number one. So desired quality and specification essentially means this for me. Number two, another thing which which Kaushal's mail highlighted was whether you're going to dictate or whether the buyer can really say that I want to take, my setup is in south, you can't mark me delivery in north. My setup is in east, you can't delivery. But the issue is, you try to imagine that at the exchange, the obligation first is done by the seller. Seller is required to bring in goods, deliver it into the exchange, go through the rigor of quality testing, specification, quantity, all of that. And once he is gone through that, once he has an email, e-receipt with him via our Comrace, he tenders his intention to deliver via that. So he has completed, or I would say he has fulfilled his obligation first. and that obligation is marked to the buyer. So what buyers cannot choose is the grade what you will get. What buyers cannot choose is the location what they can get. You have a choice to say preference. We allow buyers to tender their intention or their preferences in terms of location, not the grades, the location. But that cannot be a sole reason for it to be marked. I mean, if there is no quantity at that location, we cannot create one. We only give you what we get. So that's how it is. So I don't know when the question was whether whether you get the metal with the desired quality and this thing. So it is not about what you desire with whether that will be given. It is about what we have mentioned in our this specification, whether you will get that, and that you will get. So on aluminum in particular, it is 99.7 primary aluminum ingots is the base grade and sourced TBAS. This combination, what you will get. Our experience has been that 90% of our inventories are coming to Raipur. I can be wrong. I can tell you with a confidence that 93%, 95% of the inventory comes at Raipur, and very, very minimal comes at the other locations. So you can be probably even more confident. I can tell you that you will always get metal from Raipur. And from Raipur, I am very sure that proximity to your location will be equidistant. So whether you are east, whether you are south, whether you are north or west, I think it would be equidistant. So I hope I have answered your question, but that's what my submission is. So coming back to the questions, I only had one question for Prakash. I mean, Prakash, we deal with these queries on what you will get and where you will get on an ongoing basis. I mean, I just want quickly, I mean, because Kaushal is not here, I mean, on his behalf, I want to highlight that why he would have suggested that people should have registration at all these 5 places for delivery, so that people go back with a clear message that what are the challenges what we have seen, so that when they transact there are least amount of surprises, and while there are compliance overheads which may come, but it is happening for their good. So I mean, if you can highlight that point, and then that probably we've covered our distance pretty well.
Yes, sir. Yes, sir. The reason why the buyer needs the GST registration for all the states in which there are warehouses is that there is no guarantee that the buyer will get the delivery at a particular location. Since the allocations are random, on a random basis, so for example, if a buyer situated in Maharashtra gives the intention, so it's not necessary that he will get the delivery marked at Maharashtra location. It is quite possible that the delivery get marked at Chennai or Kolkata or Raipur, depending upon which metal he intends to get the delivery. So that is the main reason why the buyers need to have the GST registration of all those states, because whenever for example, the buyer in Maharashtra gets the allocations in Kolkata, the seller raises the invoice. It could be the CGST or IGST. So if he raises the CGST invoice, it is necessary for the buyer to have the registration of that state. So that is the primary reason why the buyer must have the registration of all these states.
Perfect. Thanks, Prakash. We still got 5 minutes with us. So I mean, if anybody has any queries, then we can take it up. Otherwise, I want to extend my sincere thanks to the panelists for doing the fantastic job. We all our credentials, all our contact details are with Metal World team, Chandekar Saab team. So I mean, if there is if you have not been able to ask the queries right now, I mean, it's harmless. Get in touch with Metal World and probably reach out to us. We'll be happy to help and guide you even in greater detail on a bilateral basis. But for time being, would like to thank for being excellent audience, and my sincere thanks to Prakash, Kaushal, Mehta. Unfortunate that he couldn't log in, and thanks a lot, Nikunj. Thanks a lot. So Chandekar Saab is over to you now.
Yeah.
One second. I think Nikunj wanted to say something. Yeah, Nikunj.
I wanted to just highlight, about that it's been 2 years since the delivery contract started, and in the lead industry already everybody is talking about MCX price क्या है, MCX price पे 2, MCX price पे low. I mean, that says a lot in itself that in 2 years suddenly there's a new benchmark for the domestic industry, so I think this is enough for everybody to understand, that the gravity and the quality, everything that what MCX is playing basically. Otherwise, for a whole industry to suddenly start talking about a new price is usually not possible. Within years and years it takes to develop a benchmark.
Yes.
So it's just that.
Great. No. We are inching and heading in that direction to do it on all the metals, and I am sure we will with the industry we will reach as soon as possible. Thanks a lot, Nikunj. So Chandrakar Saab, over to you now.
Yeah, thank you very much, all the speakers and the coordinator, Mr. Rege. I think it made a beautiful session, very informative, and I hope it must have cleared a lot of doubts, a lot of queries of all who attended. Later on, we will definitely circulate these to the industry also, so that it will benefit a lot of people and the industry as a whole. Thank you very much. We move on to our next session now. Thank you, Mr. Rege, and thank you all the speakers.